Welcome to this deep dive where we take the fire hose of information and try to extract the truly illuminating drops.
Sounds like a plan.
Today, you've handed us a fascinating stack of documents, TSMC's first quarter 2025 earnings. We're talking earnings releases, management reports, the whole nine yards.
Like quite a collection.
Or mission to cut through the financial jargon and get to what really matters, what's driving the world's leading chip maker, and what that tells us about the future of tech.
Exactly. You've given us a rich set of materials to work with. Beyond just the numbers, we'll be looking at the forces shaping TSMC's performance.
Yeah.
From the tiniest nanometer scale technologies to these big global strategic shifts.
Right.
We aim to provide you with a clear understanding of the key takeaways and why they should be on your radar.
Absolutely. We're not just reading numbers here. We want to understand the story behind them. So let's jump right into those Q1 2025 financials. What struck you as most significant?
Well, the sheer scale of the year-over-year growth is remarkable. A 60.4% jump in net profit.
60%.
Yeah, hitting NT $361.56 billion. That's what, US $11.11 billion. And revenues surging by 41.6% to NT $839.25 billion, or $25.53 billion.
Wow.
These aren't just small steps. They represent a massive expansion.
No kidding. But zooming in a bit, there was a slight dip compared to the end of last year, right? A little smartphone hangover, perhaps?
Precisely. Revenue was down 3.4% and net income 3.5% compared to the fourth quarter of 2024.
Yeah, okay.
TSMC attributed this to the typical post-holiday slowdown in smartphone demand. It's a reminder that even giants like TSMC aren't immune to, seasonal market rhythm.
Right, the predictable ebb and flow. Now, drilling down into profitability, those margins looked pretty impressive, signal some real pricing power there.
Indeed. A gross margin of 58.8%.
58.8.
Operating margin at 48.5%, and net profit margin of 43.1% in the first quarter. These are very healthy numbers, indicating a strong ability to maintain profitability even with significant revenue growth.
And where is all this money coming from? When you look at the technology breakdown, it paints a really clear picture of where the cutting edge and the big bucks are.
Yeah, what's truly telling is the dominance of their most advanced technologies. 3-nanometer chips accounted for 22% of their total wafer revenue.
22%.
5-nanometer, a hefty 36%.
So 36. It's huge.
And 7-nanometer, 15%. So you add that up, almost 3/4 of their massive revenue, 73% to be exact, comes from these leading-edge nodes.
73% from 7-nanometer and below.
Exactly. This isn't just market leadership. It's like near monopoly territory at the forefront of semiconductor technology.
Wow, that really puts their technological advantage into perspective. And looking at the platforms driving this demand, high-performance computing just leaps off the page at 59% of revenue. That's a significant jump from the previous quarter.
If we connect this to the bigger picture, that surge in HPC revenue is the unmistakable fingerprint of the booming demand for AI.
Ah, okay.
Just think, HPC was at 53% just 3 months prior.
Right.
This rapid growth underscores a fundamental shift. AI is becoming the dominant force shaping TSMC's business. Meanwhile, the smartphone platform at 28% reflects that seasonal dip we discussed.
So AI isn't just a buzzword, it's tangibly reshaping TSMC's revenue streams. What about the other sectors? Are they just sort of bit players in this story?
Not entirely. I mean, while HPC and smartphones dominate, both Internet of Things, IoT, and automotive contributed 5% each.
Okay, 5% each.
Interestingly, we saw sequential growth in automotive, digital consumer electronics, and others, suggesting a broadening demand even as, the giants fluctuate.
And geographically, it seems like North America is the epicenter of this demand. A whopping 77% of their revenue came from there.
Yeah.
Why such a concentration?
That overwhelming North American share likely reflects the concentration of major players in the AI and high-performance computing space.
Right, the big tech firms.
The big cloud providers, AI model developers, leading tech companies are predominantly based there. It highlights where the cutting-edge innovation and thus the demand for TSMC's most advanced chips is currently centered.
Okay, so we have the impressive financials. But what were some of the specific events or factors that shaped these Q1 results? I remember that earthquake hitting Taiwan.
Yes, the January 21st earthquake did have a tangible impact. It knocked about 60 basis points off their gross margin.
60 basis points.
Due to production losses and scrap materials. The financial hit was around NT $5.3 billion, net of insurance, of course.
Okay.
However, it's important to note that TSMC worked hard to recover much of that lost production, which, showcases their operational resilience.
That's reassuring. It speaks to their ability to handle unexpected disruptions. Were there any other headwinds they faced in Q1?
Well, the initial ramp-up of their overseas fabs, particularly the one in Kumamoto, Japan,
Yeah, the new fabs.
that also contributed to a slight dilution of the gross margin. Starting up new, complex manufacturing facilities inevitably involves initial costs and inefficiencies before they reach optimal production levels.
So expansion comes with its own short-term costs. Makes sense. Now, looking ahead to the second quarter of 2025, the guidance seems to point to a significant bounce back.
Indeed, their revenue forecast sits between US $28.4 billion and US $29.2 billion.
28.4 to 29.2 billion.
Yeah, that's a projected sequential jump of around 13% at the midpoint.
15% quarter over quarter. That's strong.
Very. And this strong growth is expected to be fueled by sustained robust demand for their leading-edge 3-nanometer and 5-millimeter technologies, that AI pull we keep talking about.
A substantial leap. What about the profitability outlook for Q2? Will those margins hold up?
They're projecting a gross profit margin between 57% and 59%, and an operating profit margin between 47% and 49%. Still very healthy, although the slight dip in the gross margin midpoint compared to Q1 likely reflects the ongoing impact of those overseas startup costs we mentioned.
Right, the Kumamoto effect, and maybe Arizona starting up too. And there was a mention of a slightly unusual tax situation in Q2. What's the story there?
Yes, they anticipate a temporary increase in their tax rate to around 20% in the second quarter.
20%, that's higher than usual.
It is. This is due to accruing tax on undistributed retained earnings, a sort of setting aside of tax for profits they haven't yet paid out. They expect this to revert to their more typical 14–15% in the latter half of the year.
Got it, a temporary tax blip. Now, let's dive deeper into the AI juggernaut. The doubling of AI accelerator revenue in 2025, that's a bold statement.
It really is.
What does that actually mean in practical terms?
Well, this projected doubling isn't just a number. It signifies a fundamental acceleration in TSMC's business. Revenue from AI GPUs, AI ASICs, and those critical HBM controllers for data centers is poised to become an even more dominant force. It signals a clear transition towards an AI-first era in chip manufacturing for TSMC.
And we're already seeing the evidence in the HPC numbers. That 59% is hard to ignore. How is TSMC actually meeting this explosive demand? Is it just making more chips?
It's more than that. The key here is their advanced packaging technology, specifically CoWoS, chip on wafer on substrate.
CoWoS, right.
Think of it as a sophisticated way of stacking and connecting multiple high-performance chips very closely together. It's absolutely crucial for the immense processing power needed in advanced AI accelerators.
Okay.
The fact that CoWoS capacity has become a bottleneck highlights just how fast AI development is outpacing even cutting-edge manufacturing.
So demand is outstripping supply for the packaging.
Exactly. And TSMC is responding aggressively, aiming to double their CoWoS capacity in 2025. They expect it to be fully utilized, too, with strong demand continuing into 2026.
So they're not just making the chips, they're also figuring out how to package these incredibly complex AI powerhouses. That's a critical piece of the puzzle. Now, let's talk about their massive bet on the United States. The U.S. $165 billion investment in Arizona is staggering.
It really is unprecedented.
What's the strategic thinking behind that?
This huge investment underscores a significant strategic shift. TSMC aims to build a substantial, leading-edge semiconductor manufacturing ecosystem within the U.S.
An ecosystem, not just fabs.
Right, encompassing multiple wafer fabrication plants, including for the most advanced 2 nanometers and even A16 technologies, plus 2 advanced packaging facilities and a major R&D center. This isn't just about diversification, it's about creating an independent, cutting-edge chip-making hub in America.
It's a huge commitment. How are their current operations in Arizona shaping up? Are they actually producing chips at scale yet?
Yes, the first Arizona fab, utilizing their N4 process, is already in high-volume production.
N4 is running now.
And crucially, TSMC reports achieving yields comparable to their fabs in Taiwan.
That's huge.
That's a major milestone, demonstrating that they can replicate their sophisticated manufacturing processes overseas. The second fab for 3-nanometer production is constructed, and they're pushing hard to accelerate its ramp-up to meet that voracious AI demand.
So it's not just future promises, it's happening now. What's the long-term vision for this U.S. presence? How significant will it become for TSMC globally?
TSMC anticipates that around 30% of their 2 nanometers and more advanced manufacturing capacity will be located in Arizona once this expansion is complete.
30%, that's substantial.
It is. This is a clear move to offer geographic resilience and cater to the demands of key U.S. clients who prioritize domestic production. It's also a strategic play to, strengthen the U.S. semiconductor supply chain.
Beyond the U.S., they also have significant expansion plans in Japan and Germany, focusing on what they call specialty technologies. What distinguishes these fabs?
These fabs focus on specific types of chips needed for applications like automotive, industrial, and other specialized sectors.
So not the absolute leading edge like in Arizona.
Generally, no. These often require different manufacturing processes and materials compared to the absolute cutting-edge chips used in smartphones and AI. In Kumamoto, Japan, their first specialty fab began volume production late last year and is reportedly performing well.
Okay.
A second one is slated for construction later in 2025. The Dresden, Germany fab is also progressing as planned. It's a multi-regional strategy tailored to different market needs.
And that R&D center in Arizona sounds like a crucial component of this U.S. strategy. What's its mandate? Is it just supporting the fabs?
It's vital for supporting this burgeoning U.S. manufacturing ecosystem. Initially, yes, the focus will be on optimizing production processes and developing derivative versions of their existing technologies.
Okay.
However, the longer-term vision includes more exploratory research and fostering collaborations, suggesting a growing innovation footprint for TSMC within the U.S. itself.
This global expansion, while strategically vital, can be immune to the rising tide of geopolitical tensions and talk of tariffs. How is TSMC navigating these uncertain waters?
TSMC is certainly aware of the potential risks and uncertainties stemming from potential tariff policies, like the U.S. considering tariffs on Taiwanese imports.
Right.
While they haven't seen any shifts in customer behavior yet, they are diligently monitoring the potential impact on overall demand and are prepared to adapt their business strategies as needed. It's a watch-and-wait situation, really.
Despite these global complexities, their overall growth forecast for the year remains quite optimistic, doesn't it?
Yes, they've maintained their full-year 2025 revenue growth forecast in the mid-20s% range in U.S. dollar terms.
Mid-20s%, that's still very strong growth.
It is significant confidence, especially as they anticipate outperforming the broader foundry industry, which is projected to grow only around 10%.
So they expect to gain market share.
Essentially, yes. This likely reflects their strong position in the booming AI market and maybe that advanced node leadership.
It's a delicate balancing act, capitalizing on the AI boom while navigating a complex global landscape. Now let's talk about the next wave of technology. 2 nanometer is on the horizon, and then there's this even more advanced A16. What can you tell us about these breakthroughs?
Well, TSMC is relentlessly pushing the boundaries of semiconductor technology. Volume production of their 2 nanometer, or N2 technology, is on track for the latter half of 2025.
Next year.
Right. And they're seeing tremendous early interest. They mentioned more chip designs finalized and sent for manufacturing, what they call tape-outs, expected in the initial years compared to when 3 nanometers and 5 millimeter launched.
More interest than 3 nanometer or 5 millimeter at launch. Wow.
Yeah. N2 promises significant leaps in performance, power efficiency, and chip density compared to their current N3E technology.
That kind of early adoption really underscores the demand for their leading-edge capabilities. And then we have N2P and this intriguing A16 technology. How do those fit in?
N2P is basically an enhanced version of the 2nm technology, slated for volume production in the second half of 2026, offering further improvements in performance and power.
Okay, an iteration.
Exactly. A16 is particularly interesting. It's designed specifically for high-performance computing applications like AI.
Tailored for HPC.
Right. And it features what they call a superpower rail, or SPR architecture. Think of the superpower rail as a dedicated high-speed power delivery network on the backside of the wafer, feeding the most power-hungry parts of the chip more directly.
Ah, like a dedicated power lane.
Precisely. It allows for significant performance gains in demanding AI applications. A16 is also scheduled for volume production in the latter half of 2026, showcasing their commitment to tailoring technology for specific high-growth areas.
It's a relentless cycle of innovation. Finally, let's touch on their financial health and their outlook beyond just the next quarter. What are their long-term targets?
Their financial footing appears very strong. They've reaffirmed their 2025 capital expenditure budget of US $38 billion to US $42 billion.
38 to 42 billion, still huge capex.
And a significant 70% of that is earmarked for those advanced process technologies, including investments in the U.S. Looking further out, their targets for the 2024-2029 period include an average annual revenue growth approaching 20% in U.S. dollar terms.
20% CAGR.
A long-term gross margin target of 53% or higher, and a return on equity greater than 25% through economic cycles.
Those are ambitious, but certainly seem within reach given their current trajectory, especially with AI. What about how they plan to return value to shareholders? Dividends versus buybacks?
TSMC remains committed to a strategy of profitable growth and a sustainable, steadily increasing cash dividend per share.
Focus on dividends.
Yes. They've indicated that share buybacks are not currently their preferred method for returning value to shareholders. They seem to prefer investing in growth and rewarding shareholders via dividends.
And the impact of those overseas fabs on their margins is something they're clearly factoring into their long-term financial planning. That 53% plus target includes that dilution.
Absolutely. They anticipate a 2–3% annual gross margin dilution in the initial phases of these overseas operations,
2 to 3% hit.
potentially widening to 3–4% in later years due to factors like inflation, learning curves, maybe potential tariffs.
Okay.
To address this, TSMC is actively engaging with customers on pricing, essentially arguing that there's added value in having geographically diverse manufacturing options, and that value needs to be reflected in the price.
Makes sense. They're asking customers to share the cost of that security and diversity.
Pretty much, yeah.
So, as you can see, this deep dive into TSMC's first quarter has revealed a company at the epicenter of some massive technological and geopolitical shifts. Record profits fueled by insatiable AI demand, a bold global expansion strategy, and the constant push for technological superiority. It's a fascinating picture.
Indeed. The interplay between short-term market fluctuations like smartphone seasonality and these long-term transformative trends like AI is really key.
Plus,
That significant strategic bet on U.S. manufacturing despite potential cost headwinds.
right.
And the careful navigation of global uncertainties like tariffs all create a really compelling narrative.
What are your biggest takeaways from all this? Does the sheer scale of the U.S. investment surprise you, even knowing the context?
The scale is definitely eye-opening. U.S. $165 billion is just enormous. It signals a real commitment.
And how do you see the potential for tariffs impacting not just TSMC, but the entire tech ecosystem? It feels like a looming question.
It really does. It adds another layer of complexity for everyone in the supply chain. These are the kinds of questions this analysis raises. We encourage you to delve into the source materials yourself and keep an eye on TSMC's progress in the quarters to come.
Absolutely. This is a story that's still very much being written, and, understanding TSMC is crucial to understanding the future of technology itself.